So today we're going over Finance 101, College Student's Guide to basically everything, saving, budgeting, investing, all of the basics to cover for you. We're excited to talk to you about this. If you have any questions, use the chat box, or at the end, we'll have like a section where you can ask on the mic and everything like that. As I said, I'm your moderator. I'm a marketing specialist here at Malecki Financial Group. And with me today is one of our advisors, Eric Stiles, who introduce himself, and then we'll get fully into it.
Hello, everyone. I'm Eric Stiles. I'm a certified financial planner. I've been with Malecki Financial Group coming up on 11 years next month. I help advise clients in pursuing their goals and, hopefully getting them to achieve it. And so, I'm here to help in any way I can.
Awesome. So a brief agenda, just so you know what we're actually covering: financial literacy, saving slash budgeting, intro to investing. And when I say intro, it is very brief. A credit crash course and debt repayment, because going to college, you're probably going to come out with some form of student debt. So we've got that covered here too. But Eric, can you talk to us a little bit about financial literacy?
So financial literacy, it's very important, and for all college students and young people, it's a turning stone, to learn at a young age, because if you learn, basic financial literacy, it can help you get a leg ahead the pack. Unfortunately, if it takes you a little longer to learn about financial literacy, it could get you behind the eight ball. You could build up debt, and next thing you know, you got to dig out of it and work around it. So it's really important to learn the basics of financial planning, because even though in the beginning, when you're just starting your careers out of college, or even in college, you're working part-time, it might not seem like a lot, you're putting away and you're saving, but those small habits can lead to really strong long-term results. And those habits would then be something you're building on and continuing, throughout your life. So, learning from the beginning is really essential.
So in that, I know you mentioned saving, and it is really hard, but it's definitely the first foundation. So let's go into that first.
Yeah. So generally, there's for our intents and purposes today, there's three main things we're saving for. It's we need to save for an emergency fund, our short-term goals, and to build long-term security. So an emergency fund, that is for the unexpected. That is for the unplanned. That is for my car broke down and there's a big repair bill. I fell and there's a big medical bill I have to pay. It's having money set aside that can cover the unexpected, so that when the unexpected does happen, you don't have to go and put it on a credit card that is charging you over 20% interest. And next thing you know, it's just a snowball of debt that's really hard to get out of. So having an emergency fund is essential, and it is really important to save for if you don't have one already. And then the other one's short-term goals. This is something you are planning ahead for, you are aware of. So this could be, staying on the car part. Oh, I know I need to get a new car next year, so I'm going to start saving for it. Or I know formal's coming up, so I have to save for the outfit I want to get. I know I want to go on vacation next year, and so I got to start saving for that. It's for the short-term goals. Those things are coming up, so save ahead of time for it, instead of when that month comes and you're trying to figure out. If it doesn't work out, next thing you know, it's on your credit card and you're dealing with credit card interest rates. And then long-term security. Obviously, the longest term security is to save for retirement, but that's very far away. But something that is still far away, but a little bit closer, is, eventually, buying your first home. And that is something that, you should be saving for and putting away for as well. And if you want that, the majority of people are gonna want that one day, so saving for it, early puts you in a better position. So some of the best practices you can do is to automate your savings, do the what they call pay yourself first method. Well, where whether it's in a high yield savings account, in an investment account, in a CD, doesn't matter where it is, you set up automatic instructions that on the 15th of every month, for example, could be any day, but on the 15th of every month, X amount is going to be taken out of my checking account and put into this savings. And so it's a way, and it becomes a part of your budget. It's something that, it seems like a bill because it's leaving your checking account, but really you're paying yourself and you're saving for the future. And as far as emergency funds, we generally recommend 3 to 6 months of your living expenses to be put away. So that's not 3 to 6 months of your total income. it's, if, you lost your job and you needed to stay afloat, what is the bare minimum you need to get through 3 to 6 months, so that you can take time to find that new employment and, continue on. So those are some good practices to kind of think of as well.
So I heard a bunch of account terms rumbling around in there. Not everybody might be familiar with them. So we wanted to break down four of the major ones if you want to go into those.
Sure. Checking savings accounts, those are, I think a lot of people are going to pretty understand that, but just kind of, go through it. Checking accounts, I wouldn't consider that your money check account as savings. Your checking account, that is essentially a holding account where your income comes in and then the expenses in your given month goes out. Your credit card payment goes out. Your car payment goes out. Whole Foods, grocery shopping, goes out. And so that's where checking account is more, it's an account that you can use to facilitate, paying your expenses and have your income come in. Now that you're a standard savings account, whatever bank you're working with, that's where you're putting some more money away to the side. It's not supposed to be used in flux with, a given month expenses. It's more, oh, I know in 2 months I am going on vacation and I already have my money saved for that vacation. I'm going to put it in my savings account to kind of keep it to the side until May when I go on vacation. But the majority of standard savings accounts, they do pay interest, whereas checking accounts do not. But the majority of savings accounts, standard ones, they don't pay a super high amount of interest. So if you're saving for like a long-term goal, like a goal that's, greater than like 1 year out or even greater than 6 months out, there may be a better option to put your savings in that's acts very similarly, and it's called a high yield savings account. High yield savings account actually can pay a more suitable interest level to try to pursue keeping up with inflation. A lot of the high yield savings accounts are same FDIC insured, so they're insured just like a regular savings account, just like a regular checking account, but you can gain a little bit more interest. The only downfall is with high yield savings accounts is sometimes there's a fee to have an account like that. There are a lot of high yield savings accounts that don't have any fees, and sometimes there's minimums. And then as far as there might be an extra, few days delay of processing getting your money out than it would a savings account. Regular savings account would be instant. You can get your money out. Um, then brings us on to the last one, is CDs, certificates of deposits. These are essentially agreements with the bank that I will give you X amount of my money over the next year, and in return, the bank is gonna, after 1 year's over, the bank's gonna give me that money back plus the stated interest rate that is agreed to once you open that account. CDs are a little bit of a longer dated savings vehicle. They are similar to high yield where they can pay a higher rate. The main difference is on a CD, that interest rate is locked in over the entirety of the period, whereas most high yield savings accounts, they will fluctuate based on what's going on in the interest rate environment. And so all of these can be used for essential general savings. I mentioned emergency funds. High yield savings accounts, in my opinion, are an ideal location to have your emergency fund held because it can try to keep up with inflation. And yes, there's a couple extra day processing time to get the assets out, but for the most part, it's a pretty quick transition.
So something else that you need to think about when you're trying to plan for everything like this is your budget.
Yes, so it's kind of hard to figure out like how am I on track to meet my goals or what do I need to change to meet my goals without figuring out how much money do I have coming in and how much money do I have coming out? And that's what budgeting is. It helps you identify your overall expenses and categorize it. And you may determine like, oh, I'm spending X amount on groceries. Well, I think that's useful because I don't really spend a lot on takeout. So that makes sense. Or you may see that a lot of your monthly income is being spent on takeout. A lot of it's being spent on Amazon, and next thing you know, it can, or a lot of it is on, TV subscriptions, all the different various, subscriptions that now you have to pay for if you want to watch, all the shows. You may notice that there's ways you can cut down on this on unnecessary expenses, or move your income around, and so there are tools to use it. There are tools that you can like connect your credit card connect your bank statements, and it can kind of help you categorize your budgets a little more efficiently. But also, you could do it. Not a lot of not people will do this, but I personally, I do it the old way. I have a Google sheet that I upload, that I update every single month, and I go through all my expenses and I categorize it. For a lot of people, they wouldn't do that, but there are apps that make it a little bit simpler and easier. And then as far as, what are the, key parts of a budget? Obviously, you have your income. That's the money you get from employment. Then you have your fixed expenses. These are expenses from month to month that generally do not change. Rent, car payment, um, eventually when you graduate, student loans. You know, these are fixed expenses that really aren't going to change from month to month. But the majority of the expenses are more variable, where they can change from month to month. Groceries, for example, I mean, the price of groceries will change from month to month, and also you're not going to eat the same exact food in one month that you're going to eat the next month. So it's more for variable expenses. You need to be budgeting for an extended period of time, maybe at least 3 months, and you can kind of start seeing a trend and seeing an average of what you are. And that's kind of what's useful for variable expenses, is putting that time in of tracking your budget for a few months to kind of look back if you want to project looking forward. And then the last part of your budget is the amount of money you're putting to put aside, whether it be saving for retirement, building up your emergency fund, saving for any of those short-term goals, paying any extra amount towards debts. That's where, that's another factor as well.
So how are you supposed to know how much goes to which section? How do you know it's a good budget?
So I know the order is going one, two, three, four. I'm going to start with the example first to kind of just a high level kind of tell you where your budget should look like. There's a general rule of thumb called the 50, 30, 20 rule. So in the amount of income you have, which you do by number one, calculating your total income, your salary, any of your part-time jobs, anything, you calculate it up, then how are we going to distribute that income across your expenses in an efficient manner? Uh, 50, 30, 20 says that 50% of your income that you can use to spend, at most 50% should be going to needs. That's your rent. That's your minimum debt payments. That's your groceries. That is not takeout. That is not going out to restaurants. Um, going out to the bars. Those are not needs. Utilities is a need. But then maximum 30% ideally. Now your wants at maximum should be 30%. This is all the fun stuff. This is going out to dinner, going shopping, going on vacation. This is your fun stuff. At most should be 30% of your available income. And then finally, 20% ideally should be going to savings. Like I mentioned, this could be building up your emergency fund, saving in a CD, saving in an investment account. I know we didn't talk about the other investment accounts. We're trying to keep it simple today, but saving an investment account, saving for retirement. And additionally, this could be additional debt payments. So you if you have a car loan and the minimum car payment is $400 a month, but you want to work on paying it down as much as you can, that's where, like, if you need, and then you start paying 600 a month, essentially that 200 above the minimum is considered in the third bucket of 20%, and your 400 minimum is considered in the first bucket of $50, 50%. So that's kind of how I would recommend splitting it up. So going back to the order of operations, one, you calculate your total income. We need to know that before how we can allocate, we're going to be putting that towards. Two, you list all of your fixed and variable expenses that could come up in a given month and come up on a recurring basis. You're going to have ones that come up every month, and you're going to have ones that come up every once in a while as well. But you still should try to list as much as you can. And then we need to set goals. What are we saving for? Are we saving for vacation? Okay, when is the vacation? How much is the vacation? How much should we be targeting to save per month to get to meet that goal for vacation? Same thing for the other goals as well. As setting these financial goals helps us allocate where we're going to put our budgets. So going back to the 50, 30, 20, 20% is the minimum you should be doing for saving and debt repayment. But if for those that really want to crank it up to savings, you can go over 20%. It's just you shouldn't be going over 30% in wants. And ideally needs should be around 50%. So but you can increase your savings if you want to. And then from there, it's just every month or every day. Some people it's too much to do it every day, and they at the end of every month they go back and redo all of their expenses, have a little financial planning with yourself meeting, and track your expenses and track your spending, and stay on top of your budget.
So we have to talk about investing today. It would be amiss of us if we skipped this section. So we're going to do just a high level intro to investing.
So investing is getting the hard-earned money that you worked for working for you. And so it is investing your money in there's various types of places. There's stocks, there's bonds, there's mutual funds, exchange rate funds. We're not going to go into those details, but essentially investing is getting your money to work for you and grow and pursue towards your goals. And it's allocating in an efficient manner, whether your goal is to try to produce current income, invest it that way. If your goal is to pursue getting a house in 10 years, invest accordingly for pursuing that goal. We invest to build wealth over time. We invest to keep up and outpace inflation. And of course, we're investing to achieve your goals. Now, some of the key things, start early. The earlier you start, the more confidence you will have in your situation of pursuing your goals, because that is more time, more years for interest to compound and to grow for the long term. That gives you also more time because the markets are not always, stock market's not always positive. There's down years in the stock market. The earlier you start, then the better you are, that you can deal with those negative years and still pursue your goal. And there are really simple ways that you can invest. You don't have to go and be picking individual stocks. That's very tricky. It can be a gamble. There are ways that you can invest in vehicles that entrust managers to invest across thousands of stocks and thousands of bonds. Some of them are called like mutual funds. There's also exchange rate funds that follow index. Essentially, those two are vehicles where you can invest in one thing, and that one thing is potentially give you a spread across thousands of different positions. But every mutual fund is different. Every exchange traded fund is different. So whenever you're deciding what to go into, I recommend you do your research or get advice from a professional. And just keep focusing long term. There's no get rich quick scheme with investing. There's nothing that if you invest $1,000 today, you can have it double next week. It's investing is a long-term game. The more time in you have, the more confidence we would have in pursuing your goals. And so just stay consistent. You definitely want to avoid making emotional decisions in investing, because here's what happens when the markets are all great. Everyone's talking about how great I'm doing in investing, and you hear everyone talking. Well, if you go and follow that emotion and you add money to stocks that should be more targeted towards short-term goals and not long-term goals, well, what you're doing there is you're chasing returns. You're putting in money that when the stock market is at a high, when you're investing, you're supposed to be buying low and selling high. The other part of it is making emotional decisions is the markets will go down. On average, once every year, the markets go down by 10% or more. That's the norm. It's normal for there to be fluctuations and pullbacks. So if you make emotional decisions on the opposite end, and let's say you have an investment set up that's focused on getting a house in 10 years, a long-term goal, and when the markets have a little dip, you follow that emotional craziness and the news trying to make you freak out, and you sell out. Well, you're doing the exact opposite of investing. You're selling at a low. And so really, when we work with our clients, especially during emotionally volatile times, we always talk to them, has your goals changed? Is the goal still to have a house in 10 years? And if we get yes, then okay, then we stay focused, we stay to the strategy, we stay focused on long term. But if it's like, oh no, actually I got an inheritance. We're going to use this to get a house in 2 years. And it's like, oh, okay, yeah, we do need to change that. We do need to make it safer because now it's 2 years out. So we try to make very rational decisions, and kind of really minimize the emotional ones.
So if that didn't sell you on starting early for investing, maybe this slide will.
Okay, so there's a lot going on here, but this example is we have four different people. They're all 25 years old, and they all reacted differently to investing, but they're all putting away $200 a month. I'll start from the bottom. On the bottom in green, we have a consistent saver. So we have someone that did start at 25, invested $200 a month every month through 65, but they were concerned about risk. Even though it's a long-term goal, they wanted to put their money in a high yield savings account, and just because they knew it was safer. They only gained 2.3% a year. And at the end of those 40 years at 65, she has 158, they have $158,000. Yellow, we have the lead investor. So this is someone that, you know, I don't, I'm young. I don't need to worry about the future now. I'm gonna wait. And then eventually they get in their mid 30s and they realize, oh, I need to start saving for the future now. And so from 35 to 65, save $200 a month, but they did take the risk. They did get invested in the stock market, and they got a 7% annual return. They had ended with $242,000. Now, Anastasia, what color would you say the next one we is?
Let's go
Salmon?
with pink.
Pink? All right. We got the pink box. We have the early investor. So they didn't start early. They invested from 25 to 35, but they only invested for the first 10 years. For whatever reason, they stopped investing after the first 10 years. What's very interesting here is they only invested $200 a month for 10 years, but they ended with $270,000, whereas the late investor invested $200 a month for 30 years, but ended with less money. This is the big thing where it's about starting early, because getting that money in early and getting it compounding, at 10 years earlier than the late investor massively set them, in a good position. Even if life happens, those last 30 years, I don't know what happens, medical issues, whatever, you can't invest anymore. Starting early is very important, and you see that here. And then finally, the blue one did everything right. Invested early, 25 to 60, and through the end, 25 to 65, put away $200 a month, and took the risk because they knew this was for retirement, and invested stock market, earning a 7% rate, $512,000. A massive gap between the consistent investor and everyone else. That is a massive, massive gap. If you start early, you stay consistent, and you take the risk when the goals weren't taking risk, and you were invested in a efficient manner, it can be very it could be a prosperous in you pursuing your goals. So really, really big. Just because all of you I'm talked to today are young doesn't mean you can't start somewhere. Even if it's only like $20 a month you're putting away or something like that, or $50 a month. Starting early can have confidence in your pursuit of goals.
So for now, I think that's probably enough on the investing front. We know that that can be a little bit overwhelming. So let's bring it to something that might impact you a little bit sooner. Credit.
So your credit score, if you want to buy a car, one day you want to buy a home, they're gonna look, even if you want to rent a property, job offers too, they look at your credit score. And your credit score is essentially telling these institutions how what is the quality of this potential person going to be if we're going to lend money to them. Is there a high chance that they are going to pay their monthly payments on this car payment? They're going to pay, not miss a payment. And that's credit score is used in that way. So either having a bad credit score can get you denied certain things, or at the very least, having a bad credit score can get you approved, but at a higher than standard interest rate, so a higher cost. And so there are some ways to help build and maintain a good credit. Obviously, pay your debts and your bills on time. That's everyone knows that. Pay it on time. If you miss a credit card payment, if you miss a car loan payment, that starts dinging on your history, and that's a sign to future institutions that would lend money. Hey, I don't know if we can do it with this person. This one is keep your credit card utilization low, less than 10%. So if you have a credit card that it gives you a credit line of $2,000, you want to keep, if you, and if for whatever reason you can't afford to pay off your credit card in a given month, ideally you want to have $200 or less that is rolled over to the next month. Now that is the minimum. Me personally, I think all credit cards should be paid off. You really should pursuing all credit cards paying off in full after every month. Now, the process of using your credit card through your expenses for your grocery bill, for everything, and then paying it off in full at the end of every month, that is showing future lenders that, hey, I can handle credit and there's no issues of it not getting paid. I can handle the responsibility of having credit. Um, you also want to avoid opening too many accounts. A lot of you, if you aren't already, you're going to get so much solicitation for credit cards. You do not have to open all of them. You know, you, less is more in the beginning. You know, you don't have to do every single one. You don't have to get, oh, I need this credit card because it's best as travel. I need this credit card because it's best at the grocery store. I need this credit card because it's best at everything else. You don't have to do that. You know, there are starter ones that you can do. Um, and next, you know, identity theft happens. It's very common. And so that's where we recommend you check your credit report regularly. You know, ideally once a year, ideally maybe a couple, maybe twice a year. All the main credit reporting agencies, they do offer one free report every 12 months. So if you, as you rotate through the three credit reporting agencies, you can get free reports throughout the year. I recommend you do this because if you're not tracking it and stuff happens, there's a lot of different ways for these identity theft criminals to find your information and get it. Next thing you know, you're going to uh, uh, get a loan for a new car, and they're saying, "Oh no, we can't approve you. You have all these missed payments." And next thing you know, it's like, "Wait, no, I missed payments on what? I never missed a payment." So that's where checking your credit report regularly enables you to, if there is something wrong, catch it ahead of time. And the quicker you catch it, the better, easier will be to resolve it. Um, the final one, this is unfortunately, it's just something that um, it's just time, it's gonna take time to build this up, but not so if you go to a lender to get a loan for something and everything's great, the first four things are all, are they're all great. But sometimes they'll be like, okay, everything looks great, but you don't have a long history of using credit, and for a lot of college kids, I mean, yeah, I just got my first credit card. Of course, I don't have a long history of credit. So it's just something where as time goes on and you're using credit and you're paying your bills on time, you're keeping your credit utilization low, you're not opening too many accounts, eventually you're also going to get rewarded on your credit score for the longevity of you being a good user of credit. So it is important because kind of going back to a lot of things we mentioned in the beginning, why financial literacy is important, and getting behind, if you don't do it now, you can get behind eight ball. Is if you let things go and credit card debt spirals in the beginning of your post or in college or post college career, which is very common. Not only is that amount of debt you have to get out of, that's also your credit score will have been negatively impacted. You also need to rebuild your credit score, which is just going to add another wrinkle to it. So financial literacy, very important to start from the beginning.
Pivoting a little bit because this also affects college kids a lot. Debt. You're probably going to come out
Yes.
of college with some, right?
Yes. I mean, anyone who is lucky enough to not graduate with student loans, congratulations to you. I was not one of them. So there's a couple methods that you can do to help pay down debt. Um, the first is called the snowball method. So for anyone that has multiple debts, it's all spread across the place. What essentially you do, you write down every single one of your debts and the corresponding balance you have left on it. You put it in order from smallest to largest. And so what you do in the debt snowball is you pay every single one of your debts the minimum payment, except for the smallest one. You send as much as you can within your budget extra towards the smallest debt and try to pay it off as best you can. So let's say you have three debts, um, yeah, and the smallest one is I don't know $2,000, and the smallest one you can afford to put $500 towards it. Well, you keep doing it, keep putting 500 towards it, and then eventually it gets paid off. That you now essentially you don't have to put the 500 towards small debt because it's gone. Well, what you don't then take that and spend it on other wants. What you do is you take that 500, you add it on to the second smallest debt, the minimum payment you were doing there. So let's say it was 100 was the minimum payment. Now you're putting 600 towards the second smallest debt, and you keep doing and doing. The whole intention is as you work down the line from the smallest debts to the largest debts, the amount that you can stockpile away and keep throwing extra on them gets bigger and bigger and allows you to have a plan for trying to pay it off. The other method is called the avalanche method. Similar, you write down all of your debts, and you put it in order from highest interest rate to lowest interest rate. And what you do is you focus same method, but you're focusing on the highest interest rate loan first, and then keep working your way down that list. Um, Now, a couple other key figures to keep in mind are based wrapped around debt is 36% and 28%. So 36%, uh, your total minimum monthly debt payments should not be more than 36% of your total monthly gross income. So it should be less than 36, 36 or less. 28, 28%, very similar to that. It's kind of a subset of 36%, is that out of that 36%, at most 28% of it should be going towards your housing. So that is either rent or down the road when you buy a house, that is your mortgage, your taxes, and your insurance that you're paying towards that house. These are two really good figures to keep in mind as you're considering down the road. Okay, I need to buy a new car. My current car is on its last leg. How much car can I afford? Well, you have your budget. You see how much income's coming in. You see what you can work with. But then also you go and you determine, okay, so 20% of my expenses going towards rent, which leaves, and I have another 10% of my expenses going towards my student loans. So that leaves only 6% left. That is would keep me at or below 36% of my total income going to debt payments. So as you work it out, I need to make sure whatever my monthly car payment is, it doesn't push me above that 36% mark. So those are a couple key figures to keep in mind down the road.
So we're starting to wrap a little bit, so quick tips, and then we'll go in if anybody has any questions.
All right. So quick tips. As students, you can get a lot of discounts at various places. And so, like, for example, you need a new laptop. They give discounts to students a lot. They always have back to school sales and stuff like that. A lot of food places give student discounts. Take advantage of being a student, and whenever you're looking to purchase something, look and see, do they have a student discount? There also are cashback apps that can give you money back when you purchase through using their sources. Um, you know, Number two, I kind of mentioned earlier, but you don't need to get every single credit card out there. There's a lot of good starter credit cards that are meant for people that do not have a credit history, and they're meant to get you started, get you building a credit history. So, I do look into that, start building credit, but pay off your credit card after every month in full. Like, really, don't be spending more that you know you can't pay off. Um, and also, if obviously being a student, you are really busy with classes and tests and everything, but you also probably have time. You could start a side hustle or a part-time job and make some extra income and get that saving, build an emergency fund, step one. And if that's built, focus on some short-term goals and stuff like that. And I know this is hard. Everyone does it, but avoid impulse spending. And this is where doing a budget really helps you stay on track and keep you accountable. Because if you don't keep a budget, you don't really know, like, oh, how much of how much did I spend last month was on stuff that I really honestly didn't need, or like, is there ways to cut back? And so try to avoid impulse spending as best you can. But obviously, you still need to have some fun. That's why 30% of your budget is focused on wants. So you can still have fun. It's just make sure you're accomplishing the 50% and the minimum 20% on the other end as well.
So if anybody has any questions, you can either put them in the little chat box that we have or just ask them over with the mic.
I have a question.
Sure.
So when you open your bank account as a student, you get the student rate or whatever they give you. How do you know once you graduate, how do you know if you should stick with that bank or go someplace else?
Well, you want to look at well, there's a couple of things going on. For one, you want to look at the bank's credit rating. Are they reliable? Number two, as you graduate from college, depending on moving back home or where your career takes you, you may be moving back to an area that does not have a lot of those banks locally for you to go and have access to. And so that's another thing to consider is that, convenience as well. But really, generally, all banks have FDIC insurance on your checking savings account, which is, depending on, it could vary, but generally it's up to $250,000. It could be, depending if you have varying registrations, they're all FDIC insured. So I would say, number one, if as you graduate and you're looking to figure out, do I keep my current bank or do I change banks? I think one is, well, is the current bank you're in, do they have convenient branches and locations by where you're moving to? And then two, if not, and you're looking at a new one, look at ones that are convenient there and just check you can check their credit rating and the reviews of their service and all that and how easy they are to work with, some things I can think of.
And kind of the same thing can apply with credit cards sometimes, right? Because if you get a student card and then if you want to stay with the same one after you're graduated, right?
Yeah, no, exactly. I mean, just because so you start with the student credit card, it doesn't mean you have to cancel it once you want to get a new one. The only thing is, so actually closing credit accounts actually can negatively impact your credit score. So what a lot of people do, and then also if you stop using a credit card but you keep it open, that bank or institution could have the right to close the account for you because they don't see any activity. So what some people do as they transition and they have their starter credit card, they built up good history, they paid off all their debts on time, but now they want to looking to get a card that that either can give them a higher limit and or can pay them better cash back or better benefits for like groceries or things they spend a lot of money on. What you can do is you keep that original student starter credit card open, but maybe you just sign up to one of your subscriptions you use to pay for that. For example, my college credit card, my first credit card I had, building on my credit, I still have it open. The only thing I use it for is every month it pays for Spotify. That's why you have to keep it open. It's automatic. I pay it off the $15 and change, however much it is today, these days. Um, but yeah, that's another option with the student credit cards. You don't have to close it. There are ways you can keep it open and keep it as a positive on your credit report. Because also what the credit report looks at is what is the longevity of your oldest open account. So, even though I don't use my student credit card anymore, it still is one of my oldest credit account. And so on my credit report, it really does help with my number.
What about those online banks? Are
Yes,
they any good to use?
yeah, I mean, as long as they're FDIC insured, as long as, they're convenient for use. They have good reviews and good credit rating. Yeah, there's no harm in using it. If you don't want to, if you don't want to have, don't care about having a branch to go to just in case or this or that, yeah, you can of course use it online.
I personally use an online one for my high yield savings because it offered a better rate than my regular bank.
Yeah, there's a lot of good options like for high yield. And the one thing you want to look at for high yield savings account is, like I said, some high yield savings accounts, there is annual cost, there is a minimum, but there are a number of high yield savings accounts that there's no minimum, no cost. And so just really should make before you go sign up for one and make sure you understand there are options out there that would be less expensive and no minimums.
Thank you so much for hopping on here today. I know this might not be the most exciting topic, but it is so important, especially for college students, because you're just getting started. So thank you for being here today. This is what we do. We actually have webinars every other month, give or take, and we upload all of the recordings onto our YouTube channel. If it's something that maybe you want to learn more about a specific topic or anything like that, we've got tons of resources available. You can also always shoot us an email. I'd be more than happy to point you in the direction of more resources on our website.
Hey everyone.